Are you prepared to give the government a five-figure tip on your retirement income, year after year? Because if you haven't implemented one of the most powerful and misunderstood tax strategies in Canada, that's exactly what might be happening. I'm talking about a secret that could put $10,000 or more back into your pocket annually, and the CRA isn't going to tell you about it. In fact, for 2026, they've just changed the rules on how you claim it. Stay with me, because I'm going to show you exactly how to unlock it. I see the same pattern play out all the time. A couple walks into my office, proud of the nest egg they've built. They've saved diligently, invested wisely, and are ready to enjoy the fruits of decades of hard work. Then we look at their projected tax bill in retirement, and their jaws hit the floor. They see a huge portion of their hard-earned pension and RIF income being clawed back by taxes simply because of how their income is structured. It's a silent wealth killer, and it's entirely avoidable. My goal is to get to you before you file that first retirement tax return and make a mistake that could cost you dearly. We deal with these CRA rules every single day, and I can tell you, they are not designed to be on your side. They are complex, and they prey on inaction. The fundamental problem is a disparity in income. In most couples, one partner has a larger pension or RRIF than the other. This often pushes the higher income spouse into a much higher marginal tax bracket. Let's say one spouse has $80,000 in pension income, placing them in a 40% tax bracket, while the other has only $20,000, leaving them in a 20% bracket. The household is paying a punishingly high tax rate on a significant portion of its income. It feels unfair because it is. You've saved as a team, but the tax system penalizes you as individuals. This isn't just a minor inefficiency, it's a massive drag on your retirement lifestyle. Year after year. It's the difference between taking that extra trip, helping your grandchildren with their education, or simply having peace of mind. And with the cost of living constantly on the rise, that lost income stings more than ever. The solution, the secret we're unlocking today, is called pension income splitting. It is a specific provision in the Canadian Income Tax Act that allows you to reallocate up to 50% of your eligible pension income to your spouse or common-law partner for tax purposes. It's like creating a financial partnership that the CRA is forced to recognize. Instead of one person bearing a heavy tax burden, you balance the load, instantly lowering your household's total tax bill. Think of it like this. You have two buckets to fill with water. One is nearly overflowing, while the other is half empty. Pension splitting allows you to pour water from the full bucket into the emptier one until they are both at a more manageable level. The result? Less water spilled, or in this case, less money lost to taxes. This isn't a loophole. It's a legitimate strategy designed to bring fairness to retired couples. But its power lies in understanding the details. What income is eligible, who can use it, and how to claim it correctly, especially with the new rules for 2026. To truly grasp the power of this, let's break it down into three key components: the mechanics, the money, and the mistakes. First, the mechanics. What income actually qualifies? The term pension income is specific. For those 65 and older, it's quite broad. It includes lifetime annuity payments from a pension plan and, crucially, payments from a registered retirement income fund, or RRIF. It also includes annuities from your RRSP. For those under 65, the rules are stricter, generally applying only to income received as a result of a spouse's death or from a registered pension plan. The key here is that your standard RRSP withdrawals don't count until they are converted into a RRIF or an annuity. This is a critical distinction that we see people miss all the time. The process itself is an election you make on your tax return. You and your spouse must both agree and file a special form, and this is where the 2026 changes come in. The CRA has introduced new documentation requirements for Form T-2032, the joint election to split pension income. They are cracking down on improper claims, so ensuring your paperwork is perfect is more critical than ever. You can't just scribble a number on your tax form. You need to make a formal, documented election. This form must be signed by both you and your spouse, and it must be filed with both of your tax returns. The CRA is not going to call you to remind you about this. They just send the bill after it's too late. The new requirements mean that any errors or omissions could result in your claim being denied, and you'll lose out on those thousands of dollars in savings. This isn't something you can afford to get wrong. Second, let's talk about the money. How does this actually save you $10,000? Let me tell you about a client. Let's call him David. David was a retired executive with a pension and RRIF income of $100,000 per year. His wife, Sarah, had stayed home to raise their children and had a much smaller RRIF, generating about $15,000 a year. David was in a high tax bracket, around 43%, while Sarah was in the lowest bracket, around 20%. Their household tax bill was enormous. When David came to me, he was frustrated. He felt like he was being punished for his successful career. We implemented a simple pension split. We allocated the maximum 50%, so $50,000 of David's income, to Sarah for tax purposes. His taxable income dropped to $50,000, and hers rose to $65,000. Both were now in a much more reasonable tax bracket, around 30%. The tax arbitrage, the difference between his high rate and her low rate, was dramatic. That single move saved their household just over $10,000 in its first year. That's $10,000 of after-tax money back in their pockets. For them, that meant a trip to Italy they'd been dreaming of. For you, it could mean anything. But the savings don't stop there. Pension splitting can also help you preserve other valuable tax credits. A key one is the age amount credit. For 2026, this is a significant federal credit that can be worth over $8,300 in tax savings for seniors. However, it's income tested. If your individual income is too high, you lose it. By splitting pension income, you can lower the higher income spouse's net income, allowing them to keep this valuable credit, while the lower income spouse, even with the additional income, may still qualify. It's a double win. You're not just saving tax on the split income, you're unlocking other credits you would have otherwise lost. This is how the savings can stack and multiply, often far exceeding that initial $10,000 figure. There's another layer to this that many people don't realize. When you lower your net income through pension splitting, you may also reduce or eliminate the old age security clawback. OAS is subject to a recovery tax if your income exceeds a certain threshold. For 2026, that threshold is around $90,000. If you're above that, you start losing 15 cents of every dollar of OAS for every dollar of income over the threshold. For someone with a high pension income, this can mean losing a significant portion, or even all of their OAS. By splitting pension income, you can bring your individual income below that threshold, preserving your OAS. This is another several $1,000s in savings that compounds year after year. The math is simple, but the impact is profound. Every dollar you keep out of the CRA's hands is a dollar that stays in your family, supporting your lifestyle, your goals, and your legacy. Finally, and most importantly, let's talk about the mistakes. The biggest mistake is simply not knowing this exists. But beyond that, there are 3 critical errors I see people make. The first is misunderstanding what qualifies as eligible income. People assume they can split their CPP or old age security. You cannot. These are government pensions and are not eligible for this type of splitting. People also assume they can split their regular RRSP withdrawals before age 65. Again, in most cases, you cannot. It has to be income from a registered pension plan, or, if you're over 65, from a RRIF. The timing of your RRIF conversion is therefore a massive strategic decision. If you convert your RRSP to a RRF at age 65, you immediately unlock the ability to split that income. If you wait until 71 when you're forced to convert, you've potentially lost years of tax savings. This is a decision that should be made with a clear understanding of your entire financial picture, not just on a whim. The second mistake is what I call the spousal RRSP trap. A spousal RRSP is a fantastic tool for income splitting in your accumulation years. The higher income spouse contributes to the lower income spouse's RRSP and gets the tax deduction at their high rate. The idea is that the funds will be withdrawn by the lower income spouse in retirement at their lower rate. It's a form of tax arbitrage. For 2026, the RRSP contribution limit is a significant $33,810. Making a $10,000 contribution at a 40% tax rate saves you $4,000 immediately. When your spouse withdraws it at a 20% rate, the tax is only $2,000, creating a net $2,000 tax saving for the household. However, there's a critical attribution rule. If you contribute to a spousal RRSP and your spouse withdraws those funds within the year of contribution or the following 2 calendar years, the income is attributed back to you, the contributor, and taxed at your high rate. This completely defeats the purpose. I've seen people make this mistake, thinking they can quickly access the cash, only to face a nasty tax surprise. You need to respect that 3-year window. This rule exists to prevent people from using spousal RRSPs as a short-term tax dodge. The CRA is watching for this, and they will catch it. The penalty isn't just the lost tax savings, it's the frustration and the feeling that you've been outsmarted by the system. Don't let that happen to you. The third mistake is ignoring the changing landscape of retirement income itself. The world of guaranteed, defined benefit pensions is shrinking. More and more Canadians are retiring with defined contribution plans, or group RRSPs. This puts the onus on you to structure your own retirement income, and new options are emerging. In Quebec, as of January 1, 2026, we have variable payment life pensions, or VPLPs, which allow people in DC plans to receive lifetime income. Ontario is consulting on a similar framework called variable life benefits. These new vehicles will create new opportunities and new complexities for income splitting. You can't rely on old rules of thumb. You need a plan that is active, not passive. The financial landscape is evolving, and your strategy needs to evolve with it. What worked for your parents' generation may not work for you. The rules are different, the products are different, and the stakes are higher. Let me know in the comments. Have you started thinking about how you will structure your income in retirement? Is the potential tax bill a concern for you? Your story could help someone else in this community. Now, you might be thinking, Daniel, this sounds complicated, all these forms and rules. And you're right. The tax code is thousands of pages long for a reason, but you don't have to be the expert. You just need a plan. Setting this up correctly isn't a DIY project you do on a Saturday afternoon. The cost of getting it wrong is far greater than the cost of getting professional advice to get it right. This is the kind of planning we do for our clients every single day. We build a roadmap to take them from feeling overwhelmed by taxes to feeling empowered and in control of their financial future. If you're feeling that sense of dread about your retirement tax bill and want a clear path forward, there's a link in the description where you can book a confidential consultation with our team. We can look at your specific situation and build a strategy that works for you. So, what are the concrete, actionable steps you need to take? First, you need to take inventory. List out all your sources of retirement income and your spouse's. Identify which ones are eligible for pension splitting. Remember, it's generally income from registered pension plans, and if you're 65 or over, RRIFs. Don't assume anything. Go through each source of income line by line. Look at your T4A slips, your T4RIF slips, and any other tax documents you receive. If you're not sure whether something qualifies, ask. This is too important to guess. Second, do a projection. Estimate your incomes in retirement and calculate your marginal tax rates. This will show you the potential tax arbitrage, the raw savings potential. You can use online tax calculators, but be conservative. Don't assume the best-case scenario. Plan for the reality. Factor in all your income sources: CPP, OAS, pension income, RRIF withdrawals, and any other investment income. See where you land in the tax brackets. If there's a significant disparity between you and your spouse, that's where the opportunity lies. Run different scenarios. What if you split 30% of your income? What if you split the full 50%? What's the optimal amount that maximizes your household savings while keeping both of you in reasonable tax brackets? This is where the math gets interesting, and where a good advisor can add tremendous value. Third, and this is the most important step, you need to formalize the election. For the tax year 2026, you will need to complete and sign Form T1032 with your spouse. This must be filed with your tax returns. Given the CRA's new focus on documentation for this form, make sure it is filled out perfectly. Don't risk having your claim denied over a simple error. If you're working with an accountant or a tax preparer, make sure they are aware of your intention to split income and that they include the form with your filing. If you're filing yourself, download the form directly from the CRA website. Read the instructions carefully and double-check every line before you submit. This is not the time to rush. If you have a business partner, a friend, or a family member who is approaching retirement, please share this video with them. You could be saving them from a massive financial headache and putting thousands of dollars back in their pocket. It's free financial education that can have a real tangible impact. And if you're getting value from this and want to learn more about how to protect the wealth you've worked so hard to build here in Canada, hit that subscribe button. We post new videos every week on strategies just like this one. And stay with me because I want to leave you with one final critical thought. The single biggest mistake people make with their beneficiary designations that can accidentally disinherit their loved ones. When you designate a beneficiary on your RRSP or RRIF, that money flows directly to them outside of your will. This is powerful as it avoids probate fees. However, the tax liability for that RRIF income remains with your estate. Let me tell you about a client. Let's call her Susan. She had 2 children. She named her son as the sole beneficiary of her $500,000 RRIF and left the residue of her estate, which was her house, to be split equally between her son and her daughter in her will. She thought she was being fair, but when she passed away, the son received the $500,000 directly. The tax bill for that $500,000, which was over $200,000, had to be paid by her estate. The only asset in the estate was the house. To pay the tax bill, the house had to be sold. After the taxes were paid, there was very little left for the daughter. The son walked away with $500,000, and the daughter got almost nothing. Susan had accidentally disinherited her daughter simply by not understanding how the tax liability flows. This is not something you can afford to get wrong. Your financial plan, your tax plan, and your estate plan must all speak to each other. They are not separate documents. They are one single strategy to protect your wealth and your family. Pension income splitting is a vital part of that strategy. It's a conversation you need to have with your partner and your advisor, not in the year you retire, but years before. The decisions you make today will echo for decades. Don't leave it to chance. Build a plan, take control, and ensure the wealth you've built ends up exactly where you intend it to. You're not alone in this. These are the conversations I have with successful Canadians every single day. The CRA has entire departments dedicated to maximizing their revenue. You need a specialist in your corner too. Someone who understands the rules, who stays on top of the changes, and who can see the opportunities that others miss. That's what we do. We take the complexity out of the equation and give you clarity. We turn confusion into confidence, and we make sure that the wealth you've worked a lifetime to build is protected, preserved, and passed on according to your wishes. Thank you for your time. We'll see you in the next video.